what's the most expensive mortgage I've seen? And that's over 45. That's 45%. And yes, do people take the money? Is that what you're asking?
Some lenders are actually expecting the borrower to default.
Oh, sure.
What's that about? All right, episode 1. What's up, Chris?
Not much, but I have fallen in love with this gum. Mentos watermelon. It's like mint watermelon gum.
How do they mix in mint and watermelon?
I don't know, but you know what? I was on Amazon and I bought like a 4-pack of these, and I bought it a while ago, and I ate some of the gum, but then I left 3 of these by themselves. Well, I rediscovered them in my pantry today, and I'm like addicted to them all of a sudden. So that's my big thing. You know what's awesome is the way this all looks and everything. Like, people don't know this journey started, 6, 7, 8 months ago, trying to figure out, how best to get the message out to people and whatnot. I mean, there's so many different avenues, but you always said, like, just let's try to get it 1% better, 1% better, 1% better. And like here, this feels like the exact medium for what we're trying to achieve. Like, sure, we could be, writing scripts and recording scripts and recording all kinds of stuff. But the kind of thing we do, private mortgage investing, it's very personal. You know what I mean?
It's very personal, very raw.
Yeah, it's a very personal thing. So like, it feels to me like sitting here about to do this and start down this path, I just feel like all the messages will be in here somewhere. Like within each episode, there will be something we hit on that people don't know or haven't seen or didn't think about. And all of that can be woven in with the concepts we're trying to teach people about how we do it, how we do, because how we do it works.
Just right? Your anecdotal stories of, your back and forth with investors, with borrowers, brokers, agents. It's a different type of dynamic that I'm used to, sort of interacting with people in the finance space.
Yeah, it's we're what we do really well, and so I really believe all you have to do is show people, like, share the information in a way that people can see what you see. If they see what you see, then it's easy for them to say, well, okay, I want to do this too, or I want to get involved some way. So yeah, we have, the ability here to share all kinds of stories.
So it's Thursday today. Typically, because there's a certain cyclicality to the way you manage mortgages, private mortgages at Magnetic. Mm-hmm. Does the Monday to Friday, is there like a weekly cycle, or is it strictly sort of like depending on where the loan is at, like at maturity or just getting started or midway through the loan? But as far as your sort of weekly, monthly cyclicality, is there like a certain pace that you approach the week with? Like, are there typical events on a Thursday or end of the week versus at the start of the week?
Yeah, it's a great question. First, I would say the most important thing is that our cycle is really monthly. That is the cycle of a private mortgage, because private mortgages, in general, but specifically with ours, are 1-year terms paid monthly. So the cycle of payments is every month, which puts the investors on a specific cycle as well. And then there are things that get done monthly or happen within a month that certainly have a weekly cyclical nature to them. So whether it be the underwriting side of the business where, typically it's the only part of the business where in some cases we have to emphasize speed. In most cases, we prefer not to prioritize speed at all because it's a delicate thing what we're doing. So you have to do it right. You have to take all the steps, follow all the steps. And, but in the underwriting side, when an application comes in, you're trying to move it along and get it evaluated, priced, structured, scored, all those things as quickly as you can. So there's a weekly cycle to it. And I find Mondays and Tuesdays are very busy days. I think because a lot of activity pauses on the weekend and then picks up again Monday. So typically everyone, brokers, borrowers, lawyers are all checking in Mondays and Tuesdays. So they're heavier. We send out a marketing email to all the brokers in Ontario, all the ones we can find and keep track of. We send a marketing email to them on Wednesday nights. So Thursday can be a busier morning in terms of just getting responses back and new applications and whatnot, because it's top of mind marketing. It's one email a week and just kind of says, hey, we're still here if you need us. And, this is what you could look forward to in terms of your experience working with us, that kind of thing. But outside of that, I mean, like everything else, whether it's maturity protocol, the last 3 months leading up to the maturity date and how we manage that's really a monthly process. But within each month, there's a cyclical, weekly, set of tasks, like keeping in touch. We're, in that not last 90 days, what we're trying to do is get in touch with the borrowers, have a good chat with them, get an understanding of how things have changed, if they've changed since we gave them the loan, and are they looking to discharge, or do they need a small extension, or would they like to apply to renew the loan, all those things. So there are weekly cycles in that process. And then, of course, you've got discharges that are happening, which, tend to spring up on you, right? You have a lawyer sends an email to you, just says this guy wants to discharge his mortgage, and a set of protocols goes. We follow a set of protocols from there, and that I would say is most of that is happening inside of a week or over the course of 2 weeks. So there's some cyclical processes there. So we're doing a lot of the same things on a day-to-day, week-to-week basis, but the cycle of the business really follows much more of a monthly cycle, or even quarterly, and of course annually. So yeah, it's a great question. I think like most businesses, there's probably just some processes that are like cyclical in terms of quarters or years or months or weeks.
Speaking of things that spring up on you, so I remember we were having discussions about sort of there's a bit of a negative tint that gets associated with the space, I think, especially when I got into it. Like I was speaking to buddies of mine, and we exchange, like we go back and forth on like what the best investment opportunities are, and what people are looking at in the market and stuff. And as soon as I said private mortgages, they were like, bro, what are you, a scumbag?
It's unbelievable. Yeah.
And I wanted to dive into like the reason why that is, because the more I learn about it, the more I realize like how much better off people can be after dealing with private lenders if they do need them. But why don't we start off with this? Like, what's the highest rate you've seen people pay? Like, what's the most expensive mortgage in Canada?
Okay, wait. Before I answer that, and I will answer it, where you were going there is something I actually want to touch on. So you talked about the stigma. I just think it's so important to actually address this before we answer the question that you're going to ask, because context and perspective are big factors here. Like the stigma is just, it comes from, the root of it is a lot of people don't really understand the place that private mortgages have in the market and how important it is. And we've talked about this before, you and I, but let me make it really clear for people. If you don't have private mortgages, okay, and let's agree there's no such thing as a cheap one. They're all expensive. And there are reasons for that. I'll touch on that in a minute as well, because that's it's leading right into your question. If we don't have private mortgages, we all have problems. And I'll tell you why. Because the banks, you have A-level banks, B-level banks, they're difficult to qualify for a mortgage with. Not for everybody, but they're difficult in general. And so a lot of people get good credit, good income, but maybe unorthodox income, unusual income. They get stopped, and then they have to go to a B lender, and sometimes they get stopped there too because their ratios don't work or whatever it is, because it's very algorithmic. And then they have nowhere to go. So imagine you have these people who come into the market, do all the right things, right? It's not easy to save 20%. Like, to buy a house, it's not easy to say. You got to, unless you're lucky and you run into some money or whatnot, if you built it, you got to save and scrounge and make some really good choices in order to get there. So you get there, and then you're there for the first 5 years. Everything's good. You're with the bank. You're making everything, but something happens. Somebody loses their job. God forbid somebody dies. There's a divorce. Kids are getting older. There's a different need, right? Whatever it is, something happens, and all of a sudden, you walk into the bank, and you can't get what you need. So you go to a B lender, and all of a sudden you can't get what you need either. Something has changed enough to make it impossible. Well, now you have to sell. Without private mortgages, you have to sell. And you've built equity in the property. Maybe you have 30, 35, maybe 40% equity in this. Because remember, to borrow, like, we only lend up to 80. So to borrow from us means you've got at least 30% equity in the house. And maybe we're going to give you a mortgage for 10 of it, right? 1/3 of it, up to 80%. And then you still have equity in the property. So imagine you've done that well. Like, you got 30, 40% equity in this property, but something has happened. The solution to your problem is accessing the equity in the house that you've built so that you can use it to solve whatever problem you have.
Right.
So if you have nowhere to turn to access that equity because the bank says no, then you have no choice but to sell. There's no refinance options out there. Private mortgages provide a third option, a C-level bank, if you will. They provide the ability for you to access that equity instead of selling the house. Because look how hard it was to get into the market. Now, if you have to sell just because something happened, it might be something that's very fixable over the course of a year or two with some money.
Mm-hmm.
So now, why is really bad if there's no private mortgages? Because everybody has to sell who's in that situation. There's enough of them that all of a sudden you'd have too much inventory in the market. What happens when there's too much inventory in the market to all the other people's value of their houses? It comes down. So if we put all these people on the street because they don't qualify and there's no private mortgage option, even as expensive as they are, you have a flooding of inventory into the market and you have deflation. You have, depreciation.
Yep.
So the point is that despite the stigma, the stigma is based around the pricing and the idea that if you're lending money to somebody at, ridiculous rates, then they don't pay. The thing that's attached to that is, bullying and thuggery and all this stuff. I mean, that's not what we do in private mortgages. We have security of the collateral of a house, and the pricing should be reasonable, but higher than a bank because the people giving you the money they don't have as deep pockets. They can't afford losses the way a bank could. And so you're paying a premium offering the same collateral that you're giving the bank, right? Like It's the same collateral you offered the bank, but you're willing to pay a premium in private because it unlocks that money for you, the access to your equity, lets you to solve the problem. And if you can do it inside of a year, you're doing just fine. Because if you borrow $100,000 and it costs you 10% plus a 3% fee plus legals, let's call it 15%, somewhere in that range. It's $15,000. So you borrow 100, you have to pay back 100, you get 85 of it.
Right.
Can still solve your problem. It hurts, but you get back on track and you keep going, and you're okay. So that's the place it has in the market. So now your question, well, what's the most expensive mortgage I've seen? I think that was the question.
Yes. Well, what's this?
You're talking, it's enormous. So let's imagine a second mortgage, $50,000. And let's imagine, because this is out there. The cost is 15% interest.
Okay.
And then the lender's charging a $5,000 fee. The broker's charging a $5,000 fee. The legal fees are $3,000 to $5,000. So now you're paying $15,000 plus $7,500 in interest. You're paying $22,500 for a loan of $50,000.
And people do this.
And that's over 45. That's 45%. And yes, wow. Do people take the money? Is that what you're asking?
Like you've either seen this, like you've witnessed this, or
we wouldn't do a mortgage like that because
understood, yeah.
Because the philosophy we have is we have an ethical responsibility to check to make sure that this is good for the borrower too, not just the investors.
Mm-hmm.
And so if we can't see a viable way out, if we can't see that they can make the payments on a consistent basis and sustain it, it makes no sense. This type of loan doesn't make sense. But is it out there? Yes, sure, it's out there. There's guys who will lend that money for sure. Why wouldn't they? If they have no ethics.
Wow. So 45%. Right?
It's 45%. Well, that's what the borrower's paying. I mean, remember, some of that's going to the broker, some to the lawyers. But still, the total cost of borrowing, that's the figure that we use, okay? When we're talking about this, we're talking about total cost of borrowing. That's, if I want the audience to get used to a term, it's total cost of borrowing. If we speak that language, everything will make total sense. Because really what it is how much does it cost to borrow this money for a year? Total, everything in, all the fees, everything.
And I remember you also telling me in our past conversations, not only are some lenders okay with this total cost of borrowing and astronomical fees and rates and stuff, but some lenders are actually expecting the borrower to default.
Oh, sure.
What's that about?
I mean, that's the absence of an exit strategy, right? So if you've seen a number of these and you're in my chair, you're looking at applications every day and deciding what gets funded and what doesn't. And something comes across your desk and you look at the big picture and you go, can't see a way out. I'm like, how do they ever pay this thing back? They're way over leveraged. Credit scores aren't very good. No sign of improvement. Income's okay, but it's not going to move the needle. So it's those situations where somebody who's predatory would look at that and say, person's desperate, doesn't want to sell. They'll take anything to kick the ball down the street for another year.
But if foreclosure is kind of baked into the business model, that means that they've mastered the part where it goes to court kind of thing, or?
Yeah, you become a master of the process.
Yeah.
And you load your mortgage commitment with fees and everything else, penalties and all the rest of it for the path you think the borrower is going to take.
Mm-hmm.
And then you fight in court for all that money if the borrower fights you. Sometimes the borrowers don't fight.
Oh man. Okay, so that's the part
Right?
That's sort of the cutoff where it becomes predatory. And I believe at Magnetic, you guys you don't do deals where the rate is above 11%.
Worst case 11.
Yeah. And what's
11,
what's the reason for that? What happens past 11, or what do you see past 11 where you're like, ethically just not comfortable with
It's not just ethics, it's also prudence. I mean, you look at the marketplace and you say, okay, we can lend this money to 80% loan to value, 80% of the value of a house. We feel very comfortable. And most of our mortgages are not at 80. You have to satisfy a strict set of criteria to get 80. Most of the time it's 75 or less. Our average is around 70.
Mm-hmm.
So you look at it and you go, I can get this money safely into the market and out. And I can charge anywhere between, I'd like to say we can charge anywhere between 8 and 11. That's what the investor can make, between 8 and 11. 8% on, first mortgage, really tidy, 65, under 70% loan to value, first position. So solid. I mean, for 12 months, so solid. Then it goes up from there, 8.5, 9 on a first mortgage, maybe to 75, or 9.5 if it goes to 80. And then your second mortgages are under 70, 10%, above 70, 10 or 11, depending, somewhere in between, 10.5, 10.25. You know what I mean?
So 8 to less, 8 to, yeah, go ahead.
Sorry. And you look at it, okay, and you go, okay, I don't need to go outside those bounds. I don't need to lend money at 12 or 13 or 14, because the risk doesn't change in terms of you looked at the deal and you see bigger risk or small. It doesn't change. The pricing doesn't change the risk, but not on the underwriting side. But where do you think it does change the risk?
Discharge.
Sustainability for the borrower.
Yeah, like
borrower, there's a point.
Will the loan successfully discharge?
No. Will you even make it through the term without default?
Okay, you're saying they're just bleeding too much month to month.
There's a point. There's a point where the mortgage payment's too big. And what the statistics show and what experience tells me is that when you get above 12%, the default rate midterm goes way up. Remember, we look at the collateral and we say, if everything goes wrong, can it set us free? That's number one. Can it set us free? If we make all the mistakes here, we get it all wrong, today they look this way, tomorrow they're a disaster, can't make the payments, default. Can we comfortably go through the process, sell the house, get our money back? Right. That's number one. Number two, if we're comfortable there, we should be comfortable doing the loan, but we're not, because you still want to check, like you don't want to rely on the house. Going through the court system's not good for anybody. So we don't want to be there. So we check two other things. Number one, ability to pay. So how do we control the ability to pay? We keep the interest rates in a zone where the investor is doing great. Look, 8 to 11, consistent on every investable dollar you have, even just the fixed income side of your portfolio, you're cruising. It's hard to do every year. We're boring as shit.
Yeah.
It just does the same thing over and over and over again. It's boring, right? But for the portion of your portfolio that's meant to just set it, forget it, grow, it's brilliant. For retirement savings, brilliant. Like for when you're retired and you want to just live on your nest egg, $1 million, 8%, 80
on the
grand
yield
a year.
side, like on the yield side, risk adjusted, given the collateral and everything, I have not found a better vehicle.
It's just so consistent. There are ones that will outperform it here and there, but it's so consistent, right? And we're doing everything we can, obviously, to continue to make it easier and easier and easier for people to do. But anyways, the point being, getting back to the root, I guess, would be the stigma. And you have to understand our position in the market. And then you start looking at, how do we do business? Well, you can't just look out for your own risks. The borrower is a risk. You have to work with them. You want them to be able to make 12 payments, pay you back. That's it. You're not trying to kill them. You're not trying to abuse them. Fair interest rate for the risk. The tighter, the better the deal, the better rate they should get. I mean, they're a better customer for you as a private mortgage investor, so you should treat them better.
Oh, and when the borrower is really solid, then you really want to treat them good because you're competing. Yeah,
exactly. And if you have to go to 7.5% or 7%, you're going to shake a stick at 7% every year, you're in, you're out for the gold of the gold.
In this environment, I'd be happy with 7.
Yeah, I mean, think about this. In every portfolio, there's room for a fixed income side of things. So 20, 30% of your portfolio is in GICs or bonds, right? Something just rock solid. Now, we're not a GIC, but damn, it's hard to lose at 60%, 65%, first position market. Very hard to lose. It's hard to lose at 75 or 80% if you do things right. So if you're getting 7 and you're every month payment, it's like having a GIC that pays double.
Mm-hmm.
Imagine you walked into RBC and they were like, hey, we got this special GIC for a year and it pays 7.
Oh, man.
People would flock. They'd raise so much money, they wouldn't know what to do with it all. So
it's so funny you say that, because when I closed on my property, I did go to RBC and, made the deposit, and they were like, hey, you want to speak to one of our financial advisors? And I was like, no, I'm actually in private lending, I'm happy with where I'm at. And he's like, oh, private lending, what? Can you tell me more about it? And then next thing you know, I guess he wasn't the fund manager, but he was the guy who's teeing me up for the fund manager. And next thing you know, he's taking notes. And he's like, oh, what's the firm? Whoa, how can I get involved in this? He'd never heard of it. So yeah, they people would definitely flock.
I think a lot more people have heard of it now over the last few years. It's kind of really become a little more common, but still there's a ton of people who don't, and there's a bigger portion who don't understand it. And so, hopefully, we can address that over the course of these episodes and give people a base knowledge, fundamental knowledge, very, direct, and, it's been thought through. What I'm going to share, as you can see already, it's just, logic. Let's be real about things, and hopefully people will learn more about it. It's a great space, and there's lots of room for more players. And wouldn't it be great? I mean, wouldn't it be great if we can bring private money to the market at just above those B-level bank rates, right? So, banks are at 6, we're at 7, and we're getting a little bit more, but we're enjoying. I mean, there's a reason why the banks do it. There's a reason why the banks lend money in mortgages all day long. Now, for them, they're cross-selling products and whatnot. That's a great anchor, right? To have someone's mortgage, you really have all their banking business, or a lot of it. Mm-hmm. So we're a one-trick pony. We just do the private mortgages, but 7%, 8%.
That's the goal. That's the goal. Get the word out.
Anyways, that's that.
That's that. All right. Well, episode 1 is a wrap. So we'll see you on the next one.
Sounds good.
Later.
See ya.